Okay, well, one of the benefits of social distancing and safer at home and things of that sort is I've had way too much time to play on my computer. So after we got past the initial crises that I'll tell you guys about later that came along with COVID, I did go back and take some time to rebuild the underwriting template that we're going to be learning from in this meetup. So just so you can find it, if you go to our base folder, which is available on meetup.com or on my website, we'll go into underwriting templates. There's a new folder there. This video and others as they go along will be stored under how-to videos, but you still have your original quick underwriting template that we've already been used to. This is a financial analysis template that we'll review in another video. You're going to go and click on this O3 underwriting template. For me, I already have it open. So what you're going to notice, let me see if I can move my video over here out of the way. What you're going to notice is it looks very similar to what we had before, except there are no longer two different templates for if you're assuming a loan or if you're getting a new loan on your property. I was able to actually unlock this sheet, which fancy macro was able to help me with, but to get this thing unlocked where we could build in the functionality of assumption versus new loan into the one sheet. So in a nutshell, we're going to have the acquisition underwriting, which we've already kind of gone over in the meetup, but it's going to be basically what is the property doing today in place. It's going to have a takeover underwriting tab, which is, okay, we know what it's doing in place and we kind of know how we see the numbers, but now let's take a look at what the first year of operations are going to be. This is where you really, take a look at, okay, how's the property underwriting or how's it operating today? And how are you going to make it operate in the first 12 months you own it? And most importantly, and this is really what's the most exciting part of this, you now have a fully integrated pro forma, much more useful than the one that was in here before. So I kind of scrapped it and started over and built an entirely new one. You'll notice it has some, everything in yellow are things that you would input, and it can go out as far as 10 years. What's cool about this is it's going to pull information that's not in yellow from your other two tabs. So you've already done that work. You don't have to do it again. You notice there's not really a whole lot to put in as you go down column F here, because this is all coming from your takeover tab. Now, just to show you a cool feature about this, let's say you're not actually doing a 10-year hold. Maybe you want to do a 5-year hold. If you update this cell right here to 5, it's actually going to blank out everything you don't need, and it's going to update all the calculations to only reflect the 5-year hold. That way you're not always having to see unnecessary years. So let's quickly do a quick rundown of everything that's in here, and then we'll do some other videos deep diving on the specific features. So if we go back to acquisition underwriting, again, this is very much like what you've seen before. The only difference is in here, everything on this side is the same. Well, one difference is you're actually going to be able to select cells that are locked, even if they are locked. It was a feature I was able to turn on once I unlocked the previous version. But the new features are over here. So effectively what I did is rearrange all this a little bit, and your primary mortgage info is really where you have your newest features. So before, this was only able to accept, a new loan, and it had, percentage down. It did not have anything to do with interest only, and this was kind of a dumb template, if you would. So if you wanted to use an interest only loan, you had to type in like 250 years into the amortization period. It doesn't like that anymore. I changed that, but it would actually simulate an interest-only situation. Well, now what we want this to do is to drive everything on your takeover and pro forma tab. So if you walk through each of these options here, the first is select new financing or assumption. Well, if it's a new loan, you're going to select new loan. And if it is an assumption, you're assuming the seller's loan, you're going to click right here. And all of a sudden, let me just show you that one more time. You'll notice this changes from percent down and formatted as a percentage to the actual mortgage balance that you're going to be assuming formatted as dollars. So once you do that, it will recalculate your mortgage balance and things of that sort. So you can really use either way. And we'll go over this in more detail later. You still have your interest rate, your amortization period. You can no longer do that 250-year trick that would simulate the interest only. You're going to be able to put in anything from 10 to 50 years. You don't need more than 50. I've never seen a loan that goes past 40, to be honest with you. But the key other thing here is interest only. You should be able to put this up to, what did I put it to, 50 years maybe? Nope, somewhere between, I guess it was between 0 and 30. So if it's 0 and you have no interest only period, you put in 0 years here. Now, I want you to see what happens when I do this. When I hit annual debt service of 117,504, if I go look at my pro forma and I scroll all the way down here to my debt, you'll see we have primary debt and secondary debt. You're going to see that we have a negative amount of 117,000 shown as an expense for every one of the years we own this property. Well, guess what? That's because we just said that this thing has 0 years of interest only. It pulls this from the other tab. If we come back over here and let's say this is actually a Fannie Freddie loan, and they're going to give, this is a real property, by the way. Let's say they're going to give us a 3-year loan or 3-year interest only before it switches to principal and interest. Remember that number. When I had it to 0, it was 117. When I put it at 3, it's 84,000. If we go look at our pro forma and we come down and look at the same exact spot, now we're going to see for year 1, we have, we have 84,000 for the first 3 years, and then it flips to 117,000 for the remainder. So you're a little smarter now with your debt construction than you were before with this tool. The other main thing that I've done, if we come down to closing and acquisition costs, are, let's see, there used to be a line here that was just lumped together and it said closing costs other, and that was always an issue for me because it really didn't tell you what was supposed to go there. But really, these 3 line items are pretty much all you're going to need. I mean, you have a cell for CapEx and deferred maintenance. You can make a whole nother tab in the sheet if you want to detail that out when you get more savvy. But effectively, just, what work do you have to do to the property? That's what this is. Put that in there as a dollar amount. I like to have a line item for funding of operating accounts. You'd be surprised how many people try to go into a deal with only the amount of money they know they're going to spend, and then they assume they're going to distribute money, everything that's left over, to the investors, and they don't think about, oh, hey, I need to keep some working capital in my accounts. So, depending what you have in there, for this test case, I have it as 0 just because I was matching another tool, but it's good to put, I got a little note here, maybe anywhere from 2 to 6 months operating reserves. You be the judge, right? You know your property. This is another interesting or important one. Never closed on a property where I didn't have to bring my first 12 months of insurance premium up front. Most lenders require it. Usually the lender will escrow taxes, so you don't have to worry about this, but about bringing that up front. But really, I guess this could even say just, first year escrows. But anyway, it adds all to, you add this to your total closing costs above, which adds to your down payment up here. And then when it all's said and done, you want to put this 720,000 number. So, and then the third change here, the secondary mortgage info, just has the same change as above. We now have the interest only period, and that also drives the secondary debt service here, which is currently 0, and it also drives the same thing on your year 1 or your takeover tab. So that's pretty much all there is there. Takeover is exactly the same changes as the acquisition tab, just you don't have to put them in here. It pulls them from your other tab. And then pro forma. I'm going to walk through this really quickly and then we'll go through it in detail in the class. But effectively what you have up here is some property information. You are going to be putting in the information that's in yellow. So you're going to say, how long do I want to hold the property? Let's just change this back to 5 years for fun. Okay. You're going to determine what your exit cap rate is. And that means in your sale year, it's going to take your net operating income and it's going to divide it by your exit cap rate that you put in here. And then that's going to be how you determine what your sell price is. So we'll look at that down below in a moment. These are standard assumptions, but unless you know any better, you can leave it at 2 and 2. But when you sell, first you're going to pay the broker, then you're going to pay the transfer tax, and then you get to start seeing how much money you keep. For the pro forma, it's important to say, what is your income going to increase by? Usually a good standard baseline is 3% increase in income, 2% increase in expenses, unless you're doing a value play where you're going to be forcing rents up in the first couple of years, but we'll talk about that when we start using it. And then these are just your interest only and amortization periods for your primary and secondary debt, which is pulled from your acquisition tab. So if I walk down through here, this should look surprisingly familiar to the first two tabs. It's literally just the same stuff you've already done, except one column per year. Okay, it looks like a lot more work than it is. But you're going to have your gross potential market rents, your loss to lease, gross scheduled rents. You'll walk through vacancy loss, which you're going to actually put in. You're going to put in your gross scheduled rents yourself, and then what percentage of those is going to be vacancy. As you can tell, I'm taking over a hard reposition here, so planning for a little more vacancy up front, and then I'll level it out. You're going to put in concessions and non-payment, which is effectively your other losses. And then you would have a place to put in any other income and utility reimbursement. So we'll talk about that more, and then you calculate your total income. Expenses, the only thing here, these are all pulled from your takeover tab in your year one, effectively, all these orange cells. The only thing that I've left yellow is taxes. Many states will just increase as a percentage year over year, but in Tennessee, for example, we're on a 5-year appraisal cycle, so that doesn't do me much good because taxes are usually, this is a Georgia property, by the way, so that's why you see it just going up with expenses or with 3%. I was leveraging that 3% number, 2% number over here, excuse me. But in Tennessee, you might have property taxes be exactly the same for 3 years, and then all of a sudden in year 4, you get a big tax hike. So you got to be able to plan for that and have that step change in expenses. So that's pretty self-explanatory. Other thing that was added is a pretty common expense in the industry is an asset management fee. So if your organization is using that structure, then you now have the option to put that in there as well. But other than that, these are all the same as before. Then you'll calculate your net operating income here. Take out capital reserves, cash flow, take out debt service, calculate your total cash flow before taxes. And then we start splitting up cash flow. So your company is going to have your equity split you define on the acquisition tab. Yep, can't change it here. Good. And then you're going to start talking about your equity partners' cash on cash return. So you can see what that is each year. Now here's some new stuff you haven't seen before. So you've heard me talk a lot about the total return and the equity multiple and things of that sort. You haven't had the information built in to do that. So I had to kind of go reverse engineer our commercial tool that we use to do this in a simple way in a spreadsheet. But I think I've got something I'm finally happy with, and I hope you will be too. So we'll do the projected sale value first, which is going to walk through. It's going to calculate your value simply based on your net operating income in the sale year divided by that exit cap rate up here that we talked about. First thing you're going to have to do, and this is another fancy formula that we set up, but it takes into account your loan structure you've defined already with interest only and things like that. And for each year, it's going to say, what's your loan balance at the end of the year? So for interest only, obviously, if I'm taking out a $2 million loan, I'm not paying any principal. I'm still going to have $2 million left. It's not until year 4 that I start knocking out principal, but you need to know how much you have left over when you sell so that you can figure out how much is actually yours to keep, right? Take advantage of that equity pay down. It'll do the same thing for the secondary loan if you have it. You're going to take out those commissions and transfer tax that we talked about, and this is going to be your net gain loss from sale in each year. So don't want to sell in the first 2 years because you'd lose money, as you'd expect, but you haven't finished your value play yet. So total distributions to date, these blue tabs really help you understand how's the deal as a whole performing before you break it out into yours and investors. But the total distributions to date is going to be taking the net gain loss from sale up here, and it's going to be adding together all the total cash flow before taxes, CFBT, to date. So basically, this number is going to be adding your total cash flow in the first 2 years together. You see that? And then you wind up with your total distribution to date. And this is where you start getting into the important numbers, the returns. How's this thing performing? If it's red, it's negative. Okay, so that's bad. If it's black, if you're in the black, you're positive. In the red, you're negative. You've heard that phrase, right? So the equity multiple is commonly used um, measure of how the deal is doing. It's basically a ratio of what's your net gain and loss divided by your net money in, except you don't show it as a percentage, you just show it as a total aggregate, right? So, for example, an equity multiple of 2 means you doubled your money. The annualized return here is going to be taking that equity multiple, reflecting it as a percentage, but then dividing it by the number of years you held the property, which this is actually not a very good. Let me turn this 10 years back on because this looks really bad at the moment. So these are more typical numbers on exit, right? Somewhere between 1.5 and 2.5 and 15 to 25%. So I mean, this is a real deal, but I was messing with it to make the template work. So forgive the numbers. And then in the green, we start looking at equity partner distributions. This is going to be where we have, we start looking at the same thing we looked at up here with total distributions, but we're going to figure out, okay, based on my equity split, how much of this distribution from sale is due to the equity partners? And then how much of the cash flow is due to the equity partners? And then I got to give back the equity partners principal, which was that 720,589 we calculated over here, right? So you should recognize that number. And then we have the equity partner gain loss to date, which is simply adding it all together. You see we're in this situation, we're red for a very long time, which is not a very good sign. But anyway, and then we have equity partner total returns and sale years. So this is the same thing we talked about above, just reflecting only for the equity partners. By the way, this is not a good return set for this equity partner, so we probably wouldn't want to do this deal. And then you've got an area that calculates what your company would take home. So you don't, I'm assuming here that if you're putting this together with an equity partner split versus your company split, maybe you're putting money in the deal, maybe you're not. We usually reflect it with equity partners putting in the money and we're doing the value add work. If you wanted to reflect it with putting in your money, you can do that as well. Or if you wanted to show this buying a deal just on your own, you basically just say the equity split is 100% and you own all of it, right? So anyway, but this does show on a cash basis. Here's how much money you as the deal operator would take home based on your equity split, and here's how much cash flow you get along the way. Now, over time, we might decide to build in a preferred return or something like that, but it's not that sophisticated. It just does equity split. We don't use preferred returns, so you're welcome to add on to this and do whatever you want, but it is not, it's locked so you can't mess it up, but it is not protected with a password, so you can easily go in here and unprotect the sheet and do whatever you want. So anyway, I hope you enjoy it, and we will be using this going forward on our next webinar and homework session. So everyone stay safe. Have a good night. Thanks.